Gaurav and myself will be hosting the latest edition of our CFTE FinTech and Web3 Founders podcast. Our special guest today from Dubai is Kareem. Kareem, greetings.
Hello, hello. Thank you for having me. Pleasure to be here.
How are you surviving the summer in Dubai? I believe you voluntarily flown back from the US to Dubai we're recording this on the 20th of July. So you're a brave man.
Yeah, I think being Egyptian helps a little bit, but Egypt heat is not as much as Dubai heat. But listen, the work's got to get done, and need to be here for it. So it's okay. Little breaks help, though.
The work's got to get done. I like that. Kareem, let's start off by talking a little bit about yourself. You mentioned your Egyptian heritage. Obviously, if anyone's Googled you or can listen to you now, there's a strong American influence as well. Tell us a little bit about yourself. You spent some time, you studied in the US, you went to college in the US. I believe you even served in the US Marines, right?
Yes, sir. Yep.
Wow. We both have Gaurav. This guy could probably do something.
No, I'm old now. I don't have it anymore.
So tell us a little bit about the early days of Kareem before you got into venture building and venture studios.
Sure. Born in Egypt, moved to the US when I was like 3, which is why the accent is so profound. Grew up in a couple hours north of New York City for most of my young childhood. Then I joined the military right after high school. I like to think I was smart during high school, but I wasn't very studious. There's a big difference.
Yeah.
So it was really more about what high schoolers do, playing sports and then all the other extracurriculars. So after high school, I joined the military. Thought it would be kind of good to help provide some structure and give me a little bit of guidance. And so I did that. I joined in April of 2001, and I was like, U.S. hasn't been in conflicts, any major conflicts for a while. And then lo and behold, 9/11 happened and the world changed significantly. And it was a very interesting time. But then, I transitioned out of the Marine Corps in 2003, the end of 2003. And I was, everybody, the wars were really kind of like ramping up, and I was exiting the military. And it was a very hard transition for me because my whole family had relocated back to the Middle East. So I went through some hardships, and then this is kind of what kind of set me up for my second entrepreneurial endeavor. Took a bunch of random odd jobs, everything from washing dishes, waiting tables, selling cars, which helped me make next level money at that time, and helped me with, I think, the most critical skills that I think any professional should have, which is sales skills. How to speak to people, understand, listen, etc. And then I founded my first company. It was a marketing company back in 2006 when everybody was still getting a digital presence, right? So websites, etc. And did that for a couple of years while I began my uni at a community college, just as a fallback in case I actually wasn't smart or studious and I didn't do well in community college. I would have a fallback, or if the business wasn't successful. And luckily and thank God, both were very successful. Applied to Columbia, got accepted as a transfer student, and that prompted me to focus on my schooling, full time. And so I exited my marketing company to one of the investors and one of my partners, did Columbia full time, and then graduated from there and founded my second company, which was a software company that helped veterans transition out of the military. It was called Unitus.com. And did that for a little over 4 years. Companies grown to be, raised $198 million, almost a $2 billion valuation. There's networks using this software in almost every state in the US. So great returns for investors, even greater impact on the people that it's the pain points that it's solving. And it's not for veterans only anymore, it's for the entire health and human service industry. So, and then this kind of, when I got founder burnout, I said, okay, let me just do some consulting for some startups in New York and LA. and then began doing this operational value added model, me and a team of, techies, product guys, growth marketers, growth hackers. We began just consulting for these companies, helping them break through stagnated growth, helping them get prepared to raise their next round of funding. And so we became this like value creation team, right? And we never took equity. It was always a straight, cash play for us at that time. And then our investor network was like, hey, you guys start in the companies here, and when you finish the companies here, how can we get in on this upside? So we started doing a couple of SPVs. And then this was kind of the beginning of this operational, like take what private equity does, right? But at like the VC early stage level. And this was essentially the beginning of Modus and, a la 2015, 2016, this model. And then, our investor network got annoyed with us bringing them deals every couple of weeks. So they said, okay, listen, we get the model, set up a fund. And then two of the companies we were supporting were fortunate enough to actually exit to large quasi-government conglomerate here in the UAE. And that's what made me look at the region. GITEX 2017 is when I first came here, spent all of 2018 learning about the ecosystem, talking to entrepreneurs, VCs, et cetera, and seeing if this operational value added model would work. And, we thought that it would be a good fit for venture building. And here we are.
Wow. So it was a very sort of organic development. There was no grand plan to go into venture building. It just one thing led to another thing, and Dubai 2017, and here you are. Talk a little bit about the sort of process of formalizing the venture building. How did you guys like setting up Modus Capital? Why did you not like go back and do a third or fourth startup? Why become like a player coach rather than being the main guy on the stage?
Well, it's interesting you say that. So I have one comment before I answer.
Sure.
The first comment is this is a startup. Modus is a startup. We're a platform. That has venture builder, VC fund in the future, et cetera. And so we are a startup in our own world, in our own way. But the reason why is, when I founded my last company and seeing the positive impact that it had in solving and alleviating a pain point, I thought to myself, how can I amplify my effect, right? I've always been kind of like a impact driven person. Even when I was at Columbia, like I went to Columbia thinking I'm going to go into diplomacy and I'm going to go work for the State Department, and help, US Middle East relations. And like, no, man, just, you can do so much more just by creating a tech platform to help millions of people. So in thinking, how do I amplify that? I said, well, why don't I level up, and why don't I take my experience in building companies and build a company that helps founders build awesome companies that are solving problems, right? So this was essentially the mentality. It was like, okay, I love founders, I love helping founders, so I'm helping them solve problems, and they are helping consumers, businesses, et cetera, solve their problems through the products they're creating. So this was kind of the path that drove me to do that. And Modus is still a startup, and I bootstrapped it for almost 3 years, and so yeah.
That's a fair point. You're doing a startup, and you're helping lots of you're kind of almost doing a meta startup. You're helping a lot of other startups get going. Now, when you look across all the different areas, verticals you've invested in or helped grow in your venture builder, what's worked, what's excited you most, what's given you the best returns? Those might overlap, they may not overlap, but what's worked, what's given you the best returns, what's excited you most, and where have you had the sort of maybe the biggest challenges or negative surprises?
Yeah. So as far as returns, in venture building, I mean, the way life cycle of a startup is, right? You're talking about 5 to 7 years before you begin. And again, we're very early. So our earliest companies was with our pilot in 2020 in Egypt. So we're still very, very early there. So, but there are some companies that we helped. We helped one company that actually exited. They were part of our first cohort in Egypt. But some of the challenges, it's so what excites. Let me start with what excites me. What excites me is this simple notion of alleviating pain points, right? Because our approach is very simple. Like if you create value, right? Financial returns have to come. You cannot create something that is set up a company that's creating value for a business, for a consumer, and that not have a financial return associated with it, right? Now, for VC level returns, the market has to be big enough, the pain has to be big enough, et cetera, right? And these are the considerations when you assess a company or a venture as an opportunity. So solving these pain points is the most exciting thing, and for me, like, I love the 0 to 1 space. There's nothing more exciting than putting out a beta or an MVP, the heat maps of how people are using it and interacting and what you need to fix to make things smoother and better and kind of enhance that experience. When a business gets to a point where it's like scale up and it's all about raising money and politics and the top line and the bottom line, for me, that just gets boring, right? Like, I'd like to hand it off to somebody at that point, which is why I'm more focused on the venture builder and I have dedicated people on the VC side of things, So again, I think it's seeing the impact of what it is you're creating, like achieve that goal or alleviate that friction, facilitate, progress. This is what I think is the most exciting for me. And as far as industries, I would say B2C is great, especially here, although it's very tough because let's say in the UAE, for example, it's a very high luxury like market, so there's kind of a big gap between, the top and the middle and below. But it's a lot easier there than B2B, right? Because B2B, and goes into the challenges, B2B is old school, traditional thinking, and that gets really frustrating. When you go to a corporation and you're like, hey, listen, I can give you a piece of software, right, that will save you X amount of money and X amount of time being the most valuable commodity in the world, right? Because you can't buy it, and for it to be, as clear as day, and then just not getting it or getting it, but just opting not to, this gets really, really frustrating, right? And some people are like, oh, we don't want to rock the boat, or, it's going to be too challenging because of, the dynamics of a big organization, et cetera. This gets really frustrating. It's like, when you see something and it's very clear, but you just don't reach out and grab it. That's tough because that is a huge opportunity for the space. Talk about enterprise SaaS, using distributed ledger technology, blockchain, would that have a very high utility value? These are all things that are very easily applicable and very high value to apply to these big organizations. And the adoption on it is just slow. Now, COVID has significantly accelerated that, but when the bar is pretty low and you're starting from the bottom, you still have a long ways to go.
Could you talk about one or two of your favorite companies that you've invested in or gone through the venture building program? I mean, I'm sure all your children are equally loved, but if you had to pick up one or two, and also if you can share any color on where these companies are based. So I don't know how many have gone through your program. Is this very UAE focused? You mentioned Egypt. Obviously, you've got roots in the US. Just give us more flavor of where these companies are based and what they're doing. And if you had to call out one or two, just to highlight.
Sure. So we have a couple of companies in the US, and they were kind of part of the transition from informal Modus to kind of like formal Modus. But they're also their value propositions are applicable here. And this was the reason why we kind of kept them as part of the group. We have a venture builder in Egypt. It's supported and anchored by USAID, which we partnered with them the third quarter of last year. And then we have one in Abu Dhabi that with Hub 71, and then we are setting up our operations now in Saudi Arabia after acquiring one. But so this is why I just kind of mentioned these geographies. Now, as far as the children, I love all my children. Let me talk about two. One is called Purple. So they're actually based out of the UAE, but we are actually helping them in Egypt. And what they do is they are a remittance facilitator for inbound remittances into countries that have a significant amount of inbound remittances. They started in Lebanon when the financial crisis happened there. And what they effectively do is they allow somebody to transfer money to send remittances back home and do it for significantly less and a lot more convenient than, your traditional, Western Union, MoneyGrams, et cetera. So you could go to ATM, scan a QR code from your app, and then that's effectively your mobile wallet, and you can cash out. You're not tied to a Western Union distribution center and their hours, et cetera. And we're helping them essentially expand into Egypt. Egypt, I think last year had 27 billion in inbound remittances. Like the majority of the economy runs on that. So very, very big opportunity there. So we're helping them get set up in Egypt. So that's very exciting, and not just from the economic opportunity, but the impact opportunity too. When you talk about 7 to 10% plus, 4x, you're talking about 11-12% fee, for blue collar workers sending money home, that's a big deal, so very happy about that. Another one I would say is called Oscar. What they do is they have a SaaS platform, enterprise SaaS, and we're actually getting some good traction on it, although it has been frustrating. So what they do is they essentially help organizations, when they go through procurement process, understand the positive or negative SDG impact that the vendors that they are looking at would contribute, right? So it's essentially an assessment of, your potential vendors' SDG impact again. And so if you're an organization and you have an SDG framework and you want to be able to track that into how you're actually, engaging with third-party clients or service providers, this actually allows you and enables you to do that.
Got it. I want to bring Gaurav into the conversation now, sort of drill further down into the investing and operational activities. So Gaurav, over to you.
Thanks a lot, Ronit. Very interesting so far, Kareem. Thanks for sharing, some of the stories. I'd completely forgot that you even had a stint in the military, even though we've spoken a number of times, And and in fact, Kareem's better half is actually how we know each other. A very dear friend from the early days of the startup community here in the UAE. So great to have you on the show, and great to talk more about Modus and what you're doing. So as Ronit said, I really want to get into the guts of things. You look at venture capital as a standalone model, and we've already gone through your story about how you've engaged from an organic step-by-step process into moving into venture building, from providing operational value into a more mature structure, which is defined as venture building or venture studio. But for our audience today, can you define exactly what venture building and what a venture studio is, exactly from a construct? And if somebody was parallel to that to approach you and say, Kareem, I want to engage with you from a venture builder model, what is the exact difference between a venture builder model in terms of their investment strategy, equity, time, and money versus what you do at a venture builder? So if you can take us through both those things, that'd be great in explaining to our audience exactly what that is.
Yeah, absolutely. Thanks, Gaurav. So, if I could sum it down into 2 words, it's human capital, right? That's the main differentiator, right? Well, what a venture builder does is it supplements financial capital, which is money, right, with human capital. So, you hear smart money, value added money. This is operational, smart, value added money, right? This is the way it goes. So a venture studio, a venture builder is where a group of entrepreneurs predominantly who have been there and done that, have built companies before, where they effectively leverage both capital and their experience, their knowledge, their know-how as a team to either build their own companies or support other companies, right? And these are just the different models within venture builder, which is why I say there are many models of venture building. In-house venture building, bringing companies that come to you, subject matter experts that come to you, and you build around them. There's some that focus on, let's say e-commerce. They have one piece of IP, and that's an e-commerce backend, and then they create multiple brands, for direct-to-consumer brands. But again, the core there is really the human capital. That's the main differentiator. If I could break that down into one thing.
And how does it work from a unit economics point of view? Can you take us about what kind of money goes in, what kind of percentages happen? What can you share with us for someone to understand that? Because when someone goes to a VC, effectively the older VCs that are out there, they have some expertise, not per se perhaps as subject matter experts operationally, but they have expertise because over time they build the understanding of how to build a company from a macro point of view. They won't get operationally involved per se, but they have a lot of rich experience, especially those that have seen exits, right? So when you go into that space, they say, hey, we are offering value, we are offering money to a degree, and they take a percentage of your company. How does that work in your model specifically? Can you tell us more about that?
Yeah, sure. So with our model, what we do is we would give a company at the very early stage, and this is a company that has not raised any institutional money, either bootstrapped or very small friends and family round, maybe a couple of angel checks. And what we would do is we would say to them, okay, you have this concept or this prototype, and you want to take it to the next level. We essentially, like a full service digital agency, will do a scoping exercise. The team could be for techies that built the software, but they need product support, they need business and strategy support, and they need growth and marketing support. So what we do is we do the scope, and then based on the man hours that's associated with the scope, we say, okay, of the $400,000 we're going to invest, okay, 200,000 of it is going to be in services at cost, and the other 200,000 is going to be cash, but it's controlled, your ad spend, licensing, et cetera, because you want the company to get to a certain phase where it's institutional investor ready when it actually exits the program, right? That's the goal. So we take the scope and then and we agree on the economics for it, right? And the economics, now here's something that's pretty tricky. A lot of venture builders have attempted models that have epically failed because of the economics that they take. Okay, I have seen so many venture builders say, well, we put up the money and we build it, so we own 75% of it. That is a cap table. That is a cap table that no institutional investor or educated, sophisticated investors can get behind.
And this is what I wanted to get into is because the venture builder studio space or the venture studio model is not standardized. There is no one size fits all for any of it. With the business coming to you, the founder coming to you, the requirements that they need, it's a very flexy structure, right? It's a very flexible structure. So this is what I wanted to really understand is someone approaches you, what percentages does a venture studio or venture model typically take now? I mean, you talked about instances where people take 70% because they say they built the whole company. What do you typically take as a range, if you can share with us?
So we will never take more than 25%, but where we have been averaging from the companies so far is we're somewhere between 12 to 15%, 16%. And you always hear, for example, that 15% of a couple billion is better than 75% of 500,000, right?
So Kareem, looking at the space, it's still relatively young, right? I mean, the venture builder space is relatively new from my understanding. And if you can share with us some more information about your insights about how old the space is or how young the space is, it'd be great to understand that point of view of how you're approaching it as well, especially from the investors who put their faith in you, giving you this kind of money and capital for something that's intrinsically very new. They must be how do you sell that to them, or what do they see, or what are you telling them to see that's better, especially for returns, when the model for VC is, one or two companies out of my entire portfolio will return over 100% of my capital, or will you hit 9 out of 10 home runs in this model? What's different? Can you give us that insight?
Yeah, absolutely. So although venture studio models are fairly new here, they are a little bit more mature in other markets, right? But compared to venture capital as an asset class, no, it's still very early days. So you're talking about, 12, 15 years, some of the earlier venture builders out west, Atomic, Science, et cetera. But here in the region, so the ones that have a longer tenure, they have a lot of success stories, okay, and have provided very, very high value returns to their investors, to their LPs. So you do have a successful model that you can base this off of. So the question becomes, somewhere like the Middle East, where it's a couple of years old and it's fairly new, how do you have these conversations with investors, and is it portable? Okay, is this model portable to the Middle East? And if it is, what does that look like? So when I talk to investors here, one, there's most certainly an education process, right? So I'll give you an example with Hub 71. Hub 71 had incubators, they had accelerators, and we explained venture building to them for a year before they were like, we understand how this is different from an incubator or an accelerator, right? So it did take some time. So the education process is definitely, one of the biggest milestones you have to overcome. And when you're talking to potential investors, I always just make it very, very simple. And this is relevant to the VC asset class as well. I tell them, listen, myself and the team, we are all former entrepreneurs who have been there and done that. If you haven't been there and done that, how can you make the best educated decision on how to invest in something? And this goes also to the VC asset class. If you are a VC fund that is investing in companies that are at the early MVP or like the pre-seed seed round, and you don't have the experience building that company, right? Because you have a background in finance, you came from Goldman, for example, your perspective is going to be significantly different than somebody who's a former entrepreneur. And that's why when you look at VC funds that are founded where the GPs are former entrepreneurs that invest in early stage, they are the most successful, right? Look at Andreessen Horowitz, look at all of the big VCs out west. The big ones, that they are all founded by former entrepreneurs because they've been there and done that. Now, when you get into like Series B, Series C, this is more appropriate for your finance guys, right? Because at that point, it's really more about finances. And this is where, remember, I said I bow out, right? It gets a little boring for me. I like to be at the 0 to 1 stage. So when you go to investors and you tell them, look, I've been there, I've done that, I've built a company that is, it's a couple $2 billion company, and it's not my first rodeo, and I've consulted X amount of other companies. There is a track record there, and it's not just me, it's also my team, right? All of my venture building team have built several $100 million companies and couple $1 billion companies. So I think this is one very, very important element. And then from a returns perspective, we definitely, in venture building, if you have people who have been there and done that, you're giving a startup company the best opportunity to succeed. Okay. If it has an opportunity to succeed, if it doesn't succeed with a good, well-built venture builder, then it was never going to succeed, right? Because what you're taking is people who have this experience, and they're putting that all in there. And it's a very simple concept. When you have, your son, your daughter, or your niece or nephew, and they're putting their hand and they're reaching for, the hot stove, to take their hand and pull them away, right? So these first-timer mistakes, right? This is something that venture builders really help founders do. And this helps them be more efficient. This helps the companies be more efficient with capital. And especially in an emerging innovation ecosystem like the MENA region, because how many founders have built companies from idea to exit? How many people have built companies from idea to exit here? Very small relative to the population, right? And the opportunity, right? So what's happening is I'm a VC and I'm betting on somebody who's smart, who's capable, who understands an industry very well, but they haven't built a company before. They are going to learn on your dime, and venture building helps you offset that. We've been approached by companies that were 4 years old that respectfully to them, if we were there from the very beginning, we could have achieved what they've achieved in 16, 18 months, right? So this is, you're being more capital efficient for your LPs, right? You're hand holding, you're not putting somebody who's never ridden a bike on a bike and dropping them off the biggest hill on the block. You know, it's you're holding them, then the training wheels, then you take them off step by step, and you're educating and impacting the ecosystem. And this is a major de-risking measure for LPs. So from a numbers perspective, if out of 10 companies, the law of power dynamics says that two of the companies are going to cover all of my losses and 7 of them are going to be losses, right? If we, through a venture building model, increase the successes from 2 to 3 or 4, that'll do wonders for your IRR, right? And this is essentially some of the value added benefits of venture building. And when we go and we speak to investors, we have to kind of explain this to them, you know.
So Hub 71 is a partner of yours. What's the relationship there? How does that work?
Yeah, so Hub 71 is an ecosystem enabler, right? What they do is they bring together government ministries, they bring together corporates, they bring together talent, entrepreneurs and the companies and the investors, et cetera, and put them in this amazing, dynamic and flourishing ecosystem so that there's great collaboration and you break down the traditional barriers that you have, right? And just physically being in the same place helps significantly. So with Hub 71 is both a partner and an investor in our UAE venture builder. And they have other programs. They have their incentive program, for example, which is for more mature companies. But that very early stage, right? Again, they've worked with incubators in the past, they've worked with accelerators in the past. But what they've come to realize is that venture building covers the incubation phase, the acceleration phase, and a little bit more. So it provides, its coverage of support is more broad, right? And that this is something that is valuable for them so that when the companies come out of the venture builder, they are closer to their next phase program, which is their incentive program.
One could argue that it's not a model very far away from the Y Combinator series effectively. I mean, Y Combinator, for all intents and purposes, if you boil it down to a piece, is we put you through a training program, we set you up, we give you as much experience as we have, and we spit you out in front of a whole bunch of people with wads of cash from all over the world waiting to jump in at a much higher markup than when you first came to us, right? Now, Y Combinator is a machine, right? But does Y Combinator do effectively the same thing, or is it different?
Depends on how you define it. If you were to talk about human capital, yes, 100%. But their human capital is a little less operational and more strategic. So Y Combinator, their network is insane. It's incredible, right? So if you are somebody in this industry, they will get you the not champions, plural, of those industries to help you get access, to give you advice, to support, et cetera, et cetera, et cetera. So it's a little bit less on the operational side. It's more on the strategic access and network side. And Y Combinator, so yes, to a certain degree, a little bit different flavor. But Y Combinator, and this is the interesting thing, is that they've built the brand equity that has everybody sitting at their door drooling, waiting for the next batch of companies that are coming out because they've had the successes, right?
We all know. We all know.
So,
you can't avoid Y Combinator now. It's in your face. They're so well established. But
exactly.
You know, the next question I have is for people that aren't so familiar with the space, or perhaps I'm speaking on behalf of what I perceive the listeners of this podcast or watching this on, online would want to ask you is, either as people who want to invest perhaps, or want to work with venture builders, or perhaps want to be a participant as part of your programs, right? Is you have a finite number of experts and venture builders in your team, right? And you have a program running in the UAE, and you just told us about how you're doing something in the Kingdom of Saudi Arabia. You have a finite capacity of how much you can have that team be contributing to the startups or founders that you sort of enroll and give capital to and give time to, right? So for you, it's the challenge is for VC they're trying to just invest capital and maximize returns on the high level input. For you, you're deploying time, like you talked about a $200,000 time at cost initiative, which is you consider an investment into these company programs. So what is the capacity that you can take on realistically to provide that core expertise and value to such a wide range of perhaps companies, perhaps someone's in food or someone's in AI or someone's in B2B or someone's in B2C. How do you approach that? How can you also give confidence to those people that, hey, we will give you that dedicated time?
Yeah, so it's a very good question. So for us, there is a finite amount of resources, and as a result, there's a finite amount of companies we can build, right? We can build per year, like every venture building team. Let's say the UAE, for example, with Hub 71, they can build, 6 to 7 companies a year maximum. This is the way the model is. So what we do is, we went from looking at, is this company a viable company that's worth our time and effort, to, of all of these viable companies, which ones have the highest chance to succeed and the quickest and can provide the highest returns, right? And this is essentially the way that our selection process has been driven as we've matured, and we accept less than 1% of our applicants, right? So we are very, very highly selective. And the application process, by the way, is pretty rigorous. It takes about 6 to 8 weeks to get through it. So it is a limited amount of capacity, but we do that because, like with school, the parent to student ratio, or the teacher to student ratio, has to be right, and that's what we do. And remember also, what we bring to the table is, we don't bring the domain expertise, right? Let me just be clear. I am not a fintech expert. I'm not a marketing tech expert, a med tech expert at all, right? But what I know how to do is, I know how to build tech startups, and building a tech startup, irrespective of the industry that you're in, about 70% of it is the same, data-driven product iteration cycles, data-driven marketing cycles, et cetera, et cetera, et cetera. Like those are standard. And that's what we bring to the table. We bring that to the table on the operational side. The founders need to bring the domain expertise, and then we support domain expertise through a venture partner network that we're still building, where a fintech expert in the UAE, one in Saudi, et cetera, where they can have like that local domain knowledge to be able to support.
So how big is the team today in the UAE and in KSA?
So I think total between the UAE, KSA, Egypt, I think we're a little under 60 people.
Oh wow, that's a large amount. I mean, usually, yeah, that's a pretty large amount. And can you share with us the size of capital or the size of the fund? Is that something that's public knowledge?
So as of right now, we have about just under $10 million for our UAE venture builder. And it's all in one fund. And we actually have just begun formally fundraising for the venture builder fund. Because remember, we're doing two things. We are building a team and a company and an operations and IP, et cetera, while we are fundraising. Whereas a fund manager just has to fundraise. They don't have to build a team. So what we've been doing is building these teams for the past few years, Egypt, UAE, Saudi, and along the way, we're having conversations about fundraising, but now we are actually exclusively focusing on the fundraising now that the operations are set. But the fund for the Egypt, UAE, and Saudi is a total of $50 million.
And so is the cost dynamic of running this naturally higher? I mean, when you do a fund as an investor approaching it, there's a 2% management fee annually for a number of years, or for the life cycle of the fund. And there's a 20% carry. So any profit that's made from the investments, there's a 20% that goes to that. 2 and 20 is what everyone knows call it. Is it different for a venture builder?
So it can be. There's different models. For our model, we have the 2 and 20 model, but the differentiator here is we use LP capital that would be traditionally deployed to invest in a company. We use part of that to cover the OpEx at cost, which is, remember when I told you the OpEx is run at cost. So this is our model, because there's no way you can sustain a staff of this size, or a staff to actually venture build companies on a 2% management fee. And this is historically, by the way, the challenge of VCs, right? A VC has to have so much AUM to be able to scale its value creation team, right? To a point that it can provide strong enough value to the portfolio to attract the best companies, right? And that takes time, you know?
And another thing is talent within your own organization. Typically what happens in VCs over a cycle of 3 to 5 years is they have junior associates and associates who join their organizations. They become subject matter experts. They, are the tip of the spear in scouring the market for potential opportunities that are outside of the traditional realms of what happens between VC networks, right? And what I'm getting at is these associates, after 3 years or 5 years, leave because they start up their own organizations, because obviously they're on a path to grow themselves. How do you retain talent, or these operational subject matter experts that are part of your organization and your management, which you give to these companies? Are they incentivized beyond a salary as well? Do they get some sort of an aspect to keep them going as well, so they earn perhaps some kind of an ESOP in these companies as well, so that they're incentivized to keep contributing to it for the life cycle of its natural exit?
Yeah, so we do it in 2 ways. The first way is compensation package, and the second is optionality. So on compensation package, yes, there is not a single Modus employee that does not have part of the carried interest of the venture builder fund. Okay, it's compartmentalized. So for example, the team that's building the UAE companies, that SPV, they all get equity options in that SPV. So every company that they build, they have sweat in the game, and they're incentivized, right? They're incentivized to do the best job possible. Also on comp, there's salaries, and then we're bringing a little bit of that, West Coast laissez-faire startup culture to the region, which has been a very interesting mix with a laissez-faire Middle Eastern culture, but we have like unlimited paid time off. People get equity and they get bonuses. There's a professional development budget that we have them use so that they continue to enhance themselves and develop. There's a flexible work schedule. In the summertime, we have like 3 people that are in the UK, and they're going to be there for the next 6 weeks, and they can work remote. So we have this hybrid working model. So all of these things put together make a very nice compensation package. It's not if you are looking at an option like this versus somewhere where you have to clock in and clock out 9 to 5 every day, you have a lot more flexibility on this, and you're also incentivized very well. And the other point is optionality. And what I mean by optionality is not optionality to work from home or work from the office or work from the south of France. It's optionality to go and work for one of the companies that you've been building, or if I have a head of product and they've worked with us for a couple of years, and there's a startup that they're working on that they just absolutely love, and this startup is getting ready to leave our venture builder, and they're going to need a product manager or head of product, we want this startup to have the best talent. So we are happy to give them our internal operations team, and we have a structure to be able to make sure that transition is smooth, and we have somebody in our pipeline to fill that gap in, right? So we give them that optionality. If they have a concept and they want to be a founder and they want to venture build it through Modus, they can do that. They can flip and become a founder, right? In the same respect, when you have an employee of one of our portfolio companies that's been working on this enterprise SaaS product for 3 or 4 years, and they want to taste a different flavor, they can come back to Modus and either work at any of our other portfolio companies or at the venture builder if there's an opening for it. So this is what I mean by optionality, right? There's kind of like this ecosystem which gives you this optionality because Modus is an operating company, not just an investment company, in addition to all of the other portfolio companies.
In your viewpoint, with the way you've been in this region for a while and you've looked at the landscape and you can see what's happening around here, do you think venture builders and venture studios will generate more exits quicker than venture capital investments?
I
had to try. I wanted.
No. I say yes, but I'm cautiously optimistic about it, right? And
All right.
Let me tell you why. One is because there's been a lot of hype about venture building. You have people and there's funding for venture building because right now there's a shortage in deal flow. There are VCs that are sitting on dry powder and they don't have deals to invest in, like quality deals I'm talking about. So venture building is needed to educate the ecosystem, to produce investable companies, et cetera. And because there's funding for it, you have people who respectfully have no business doing venture building, trying to do venture building. And this is a risk for something that is such a new concept, because if somebody gets $30 million to do venture building and they epically fail because they don't have venture building or tech building experience, that's a very bad indicator for the entire ecosystem on venture building, But on exits, let me tell you, here's one of the unique things about venture building, and we've done this a couple of times. You can build a company in 12 or 18 months, knowing that it will get acquired in 18, 24 months, because you have the team to be able to do it. Whether you do it as a land grab of market share, because you know that it'll get rolled up into one of 3 companies that are competing for market share in the same industry, and you're able to grab this market share, whether it's you're doing it because there's a major problem with corporates and conglomerates, and this is something that can be an easy acquisition target. Because you have an operational team, you can build to be able to exit. Now, here's the thing. On the exit, it's not about the transaction value. It's about the multiple that you get, right? So if I build something and it costs me $3 million to build it in 2 years, right? But I sell it for, 20, 25 million, and I do that in a couple of years, that's not bad, So they don't all have to be home runs. You can have singles, doubles, triples as well.
And my last question before I hand back to Ron, because I'm conscious of the ticking clock I have, is there are a lot of people who listen to our podcast globally, and more so regionally, because that's where we are very familiar with people in the ecosystem, from startups, incubators, VCs, angels, everyone in this space, very entrepreneurial space. Mm-hmm. What message, if you could use this as a podium to shout out to everyone and communicate to them about Modus, what would you say as a broadcasted message would be your way of reaching out to people who should come and talk to you? What are the kind of people who should reach out to you, talk to you, engage to you from an idea point of view or an entrepreneurial point of view? From which sectors, and where would you love to see people reach out to Modus?
Sure. So I would say if you are driven to provide positive value, right, as an entrepreneur, right, I would say come and talk to us. If you are driven to be impactful and support with positive change, I would say come and talk to us. If you're a little cuckoo and you got a few screws loose and you're an entrepreneur and you like to jump and then build your parachute on the way down, definitely come and talk to us. So for us, it takes, you guys know this, right? It's being an entrepreneur, it's something in your DNA, it has to be in your DNA. And I can't really put my finger on it, but it's a combination of like drive, purpose, And again, just got to be a little on the on the loose side to be able to do it.
Listen, Kareem, thank you so much. It's been a pleasure having you as a guest on the podcast. And I'll hand back to my co-host with the most, Ronit. Take it back, brother.
Awesome. Thanks, Gaurav.
Thanks, Gaurav. Kareem, thanks so much for joining us today. Maybe one last kind of question or discussion area. So you've kind of came back to the Middle East, dived into the Dubai and UAE scene around 2017, you've said. You've been here a few years now. How do you see this region in the global environment? I mean, VC investing, let alone venture building, is a relatively new area in this space, in this region. I mean, you've got the option of spending time working in the US. Why the GCC? Why the Middle East? Why UAE, Saudi, Abu Dhabi, etc.? Think about the next 5 years. What's keeping you here?
Yeah, so it's a really good question, because I feel like I have the ability to be more impactful here than in the US. Okay. In the US, you are at the very cutting edge of innovation, and that innovation is impactful. Okay. But the challenges here are like 101 challenges, like think about Purple that I mentioned, talking about transferring money to your family in Lebanon or in Egypt, right? Or in one of these Levant or North African countries. This is, the ability for what you do to have a bigger impact is significantly higher here. And I'm also Egyptian, and remember when I mentioned being impactful and wanting to do something in the Middle East, this really drove me back here. And the region has incredible potential. But I do believe that there needs to be a little bit more tactfulness in the approach of some of these, essentially the stakeholders that are supporting the development of this ecosystem. Throwing money at problems, right, will kind of solve a problem, but it's going to create a whole other set of problems, and then throwing money at that, and it's just cyclical, right? And look, if you have the money to burn, great, but there's a more efficient, more tactical, more effective way to do things. And this is something that, I hope to see continue to change more and more for the better, because the Middle East, GCC and the Levant and Egypt is actually a much bigger population than the US. It's over 350 million people. So when you talk about yes, it's fragmented, but if you talk about market size, the opportunity is there.
Kareem, thanks so much for joining us, and look forward to the years to come and watching you build in the region.
Awesome. Thank you so much for having me. It's been such a pleasure, and I hope you found it valuable.
Take care. Thanks so much.
Thanks.